Whether we like it or not, there's a lot of stuff happening in the world right now. And not only is it affecting the world around us, but it's also affecting the markets, especially the currency markets. And adding this type of analysis, fundamental analysis, to your tool belt can help you grow your account as well. So let's talk about it. First of all, there are two camps of retail traders when it comes to fundamental analysis: the ones who use it and the ones who don't. In my opinion, I feel you should use it because it can help you increase your win rate if you're using fundamentals the right way. So let's talk about the difference between technical analysis and fundamental analysis. Now, technical analysis, it's more using the study of the actual chart. It's about looking at what you see on your screen and attempting to make predictions of where the price might go using what you see on the actual chart itself. So it could be looking at various different candles, looking at what the candle looks like, or even using past historical data and trying to find patterns or trying to look at various different trends to determine where you should enter your trade and when you should enter your trade, or where you should exit your trade and when you should exit your trade. Now, fundamental analysis, it's more about understanding what's going on in the world around us, trying to see what's happening economically to a country and a currency to determine whether that currency's value is going to increase or whether that currency's value is going to decrease. And putting both of these together, you can have a very powerful strategy. In essence, fundamental analysis is more used to help you understand the direction of the trend, whether you should be looking for a long or a buy or a short, which is a sell. So this way you can at least understand which direction you should be trading. Now, technical analysis is more used to determine when you should enter your sell and when you should enter your buy and where you should enter the buy on the actual chart. So for example, if you know from fundamental analysis that you're looking for a buy, looking for a long position, now you got to figure out when you should actually enter. So you can ask yourself based on technicals, should I enter now or should I wait a little while until technicals are more aligned in my favor and then strike when the time is right? So essentially, technical analysis tells you when and where to enter and when and where to exit. So now that we kind of have that established, let's talk about fundamental analysis. Fundamental analysis essentially tells you why the market is priced where it's at, and it tells you why the market is actually moving. Because without fundamental analysis, you're actually just trading blind. You don't know why the market is moving. You're just looking at it based on numbers and visually what you see on the chart. But using fundamental analysis can help you clear out that fog and help you understand why the market is moving a certain way. Let me give you an example of value. This is a metaphor that'll kind of help you understand why fundamental analysis is important. Let's say you bought a watch, a Rolex, years ago, like this guy. And let's say you bought it for like $300-400, just like this guy. And this was years ago, but let's say you wanted to make some quick money and you wanted to sell it today. So let's say you just go on Facebook Marketplace, OfferUp, or Craigslist, and you kind of post it online just to sell it to make some quick money. So you're expecting to sell it for like $3,000-4,000, whatever. But let's say you actually decided to get it appraised just to see what the value would actually be. Turns out, based on various different fundamental factors about the watch market and even that watch itself, that watch isn't worth a couple $1,000s, but instead it appraises it for $400,000, even $700,000. And that gap, the amount of money that you would have sold it, but the real amount of money of what it's actually worth, that gap is an opportunity to make money with fundamentals. And that scenario that I just went over about the watch getting appraised for over $500,000 actually did happen, and the guy fainted. So side note, I'll link that little video down below. But let me put it in another perspective. Let me give you a different scenario. Let's say you're in the market to buy a house. You're just not going to go to a house, look at the price, and just buy the house. You're going to actually try to see what the actual value of the house is. You're going to inspect the house. You're going to look at different houses in the neighborhood to kind of see where does this house line up compared to other different houses, because this will allow you to negotiate. You're going to do your actual due diligence. Nowhere in your life do you look at the price and not try to understand the actual value. And that's what fundamental analysis is. It's about trying to understand the value of whatever asset class that you're trying to trade. And this is why fundamental analysis is such a key component to many professional traders' trading strategy. Every financial institution who manages a significant amount of money uses fundamental analysis. In fact, they have specific divisions dedicated to fundamental analysis, and they hire people who have PhDs in economics who do this day in and day out to help with the fundamentals. And I hear traders all the time say,
I want to follow the institutions. I want to follow the big banks. I want to trade like the banks trade.
And then they trade like every other retail trader, Joe Schmo, with their blinders on, looking at just technical analysis, and then they get absolutely twerked on by the big boy institutions. Now, there aren't a lot of videos on YouTube talking about fundamental analysis simply because it's such a complex topic and there's so many different layers. And most people in general just aren't interested in fundamental analysis because it is pretty complex. And people would much rather watch videos of people showing different patterns on a chart. So let's try to break this down pretty simple and straightforward for you. Just imagine fundamental analysis being split up into like 3 different pillars. Pillar number 1 could be cross-economy relationships, and pillar number 2 could be the economic calendar, and pillar number 3 could be various different geopolitical factors. Don't be overwhelmed by these keywords and whatnot. Basically, cross-economy relationships, essentially what that means is it's about understanding how one economy's currency affects the currency of another economy. Because we can't look at the world and countries as completely separate individual entities. Various countries affect each other. That also affects the currency valuation in between various different economies. So just think of it like an interwoven like spider web or like a pretzel. Let me give you an example, because we know Canada is essentially America's hat, right? They're right above us. So Canada does a lot of trading between the US. So we have a relationship between each other. So our economies are affected based on what's happening in various economies. Another example, New Zealand does a lot of trading with Australia, so the NZD is also affected by what's happening in Australia. And looking at GBP, the Great Britain pound, if you look at it on a map, you'll notice is right next to Europe. So the GBP is also affected by what's happening in Europe because they have a relationship between each other as well. So I encourage you after this video, go down the rabbit hole just a little bit, just try to figure out what affects various different economies in the world around us. Because you just need to learn this one time, because once you understand the basics, you're good for the most part. Number 2, the economic calendar. You just Google economic calendar and you can pull up many different websites that have economic calendars, but pretty much what this is, it's just pre-scheduled events that are going to happen. It's like numbers that are going to be released and figures that are released every month, every quarter. These numbers that are released on the calendar help us gauge and understand how an economy is doing. How is Europe doing? How is the US doing? How is the US doing compared to last month or the month before? Is the US getting stronger? Is the US getting weaker? Is the economy doing good? Is the economy doing bad? It helps us understand what's happening with the economy. So this way you can make a decision on whether you should be looking for a buy or whether you should be looking for a sell. Now, these events that are released on the economic calendar are released to the public at the same exact time for everyone. So on these economic calendars, you'll see like a little countdown for each event of how many minutes or even how many seconds are left until that number is released. So whenever these numbers are released, especially if this event is a very high impact event, that event could cause massive spikes in the market for the next 2 minutes, 5 minutes, 10 minutes, 30 minutes, even an hour, depending on how crazy of a number that got released was. So there are people who use the economic calendar and put in a buy and they put in a sell before the number is released prior to the countdown finishing, because they think that the market is either going to spike up or they think the market is going to spike down, and they enter the trade before it spikes in hopes to make a lot of money off of that one trade, because that trade could go up 70 pips within 2 minutes. So you can make $10,000, $15,000, $20,000 in a couple minutes if you do it the right way. However, I do not ever encourage or even suggest anyone do this, because doing that, trading the news like this, is absolutely gambling. So do not trade the news, in my opinion. Instead, use the economic calendar to help you understand and give yourself that fundamental idea of what's actually happening in an economy. Is the economy doing good, or is the economy doing bad? Now, pillar number 3, geopolitical factors. And pretty much what this is, these are things that are happening in the world that aren't pre-planned on the economic calendar. So this could be things that are happening like a pandemic or a recession or even lockdowns or even like elections that are coming up. Or it could even be just the inflation rate. If someone notices that inflation is higher or prices are getting higher, it's about understanding what's actually happening within a country itself. Because if there's a pandemic, that's going to affect the markets. If a country goes down into a recession, that's definitely going to affect the markets. If elections are happening, that could also affect the markets. So for geopolitical factors, you would just Google and search different websites that give you various different headlines of what's going on in the forex markets. And you would just follow those headlines and just kind of build yourself a fundamental analysis idea. Follow various different fundamental analysis events that are happening in the specific currencies that you want to trade, And after a month, 2 months, 3 months, you'll have a very, very solid understanding of what's happening in that economy, or whether the economy is getting strong or whether the economy is getting weak. And by understanding that, you can have a very, very high accuracy understanding of whether you should be looking for a buy or whether you should be looking for a sell. You've essentially taken off your blinders and can understand why the market is moving up or why the market is moving down or why the value of a currency is the way it is. Because just know, various different fundamental factors can last for just minutes, or if it's big enough, that fundamental can last for years. There are many trading opportunities each week when it comes to fundamentals. So yes, fundamental analysis is relatively harder to understand and grasp compared to technical analysis. And I'm glad it's this way. Because if it was easy, then everyone would do it. And if it was easy, then everyone would be rich. So that leaves room for those of us who take trading seriously to take advantage of the things that are happening fundamentally when it comes to the markets. Let me give you an example. Let's look at the DXY, which is the US dollar currency index. The currency index, the value of the US dollar isn't going up just for fun. It's not going up just because of technicals. There's a reason why this value is going up. So let's look at an actual chart itself, USD JPY. This currency pair isn't going up just based on technicals. It isn't going up just to go up. There's a reason why it's dramatically in the past few months has completely shot up. There's a reason. And if you understand the reason, which I will explain in another video, if you understand the reason why it's going up, you can make a lot of money, and you could have made a lot of money through this whole run just from here. Over 2,300 pips on USD JPY. For those of you who have been trading for a while know USD JPY doesn't really move all that much. It isn't really all that volatile. So 2,300 pips is absolutely insane, especially for this specific currency pair. But again, I'll talk about that in another video. In fact, I want you guys to go to the comment section and just tell me, why do you feel that the US dollar is going up? What's your opinion on that? I'm actually genuinely curious to see what you guys have to say. It's interesting. So to close this out, remember, we use fundamental analysis to simply determine the direction of the trend or the direction of where we should enter our trade, whether we should be looking for a buy, whether we should be looking for a sell. And technical analysis we use to figure out when and exactly where we should enter the buy or where should we enter the sell. So hopefully this introductory video shed some light, give you a little bit of context on how traders, professional traders, use fundamental analysis. So add this to your tool belt, and I'll catch you guys in the next video. Take care, guys.